Welcome to another public live stream, and man, do we have a lot to talk about. So let's discuss the dividend investing strategy for financial independence and retire early. And I'm going to get right into it right now. So here we go. First, let's talk about what a dividend stock is and how you generally get paid. A dividend stock is when the company pays out its earnings as cash payment to the stock, the shareholders. Usually, companies that are well established but not having a lot of growth will pay out higher dividends to their shareholders. And if you look at stocks like Amazon, Google, and Meta, they don't pay dividends because their share prices continue to gain over the years and possibly over the next 5 to 10 years. And those companies would rather use their earnings to reinvest into their business to grow their companies even bigger, right? And if you look at stocks like, let's say, Southwest Airlines, Texas Roadhouse, and McDonald's all pay quarterly dividends because they use consistent dividend payouts to attract new investors and show the strength that they're going to continue to have positive earnings going forward. And they're not necessarily growing as fast as some of the tech companies I mentioned, so they use dividends to attract new investors. And I just want to make sure the audio is working correctly here. Let me know in the comments section if anything is not working correctly. Hey, how's it going, Sim? All right, thanks for being here. All right, so then the formula for the dividend yield is the annual dividend per share divided by price per share. So for example, let's say if the stock's annual dividend rate is $2, okay? And the stock price is $50 a share. And then your annual dividend yield will be 4%, right? So because $2 divided by 50 will be 4%. And just keep in mind that the dividend yield changes when the stock price changes. The yield will rise when the stock price drops, and the yield will drop when the stock price rises. So let's say, let me erase this. Okay. So let's say I buy a stock, ETF, or mutual fund for, let's say, $10,000. Okay. And the price per share is $50 a share. I have a terrible handwriting, I know. And with the $2 per share in annual cash dividends. And this means that I have 200 shares, and it pays me $400 in dividend payments every single year, right? And when I'm choosing a stock to buy, the easiest way for me to look at the annual dividend payout is by just looking at the current yield. But if it's yielding 3% with a, let's say, quarterly payments, 10,000 with 3%, okay, then there will be $300 a year, or what is that? $75 per quarter, because 10,000 multiplied by 3% is $300, right? And then divided by 4 quarters, and then and that would give me $75 every quarter. But again, this is assuming that the dividends don't get increased, and I'm just kind of giving you the great, having a teachable moment here. All right, awesome. So, and speaking of quarterly dividend payments, so most stocks, ETFs, and mutual funds pay their dividends on a quarterly basis. Some companies choose to pay out their dividends semi-annually or annually. And I think the company Activision Blizzard, before it got acquired by Microsoft, and I think there are some lawsuits for the acquisition, but they used to pay annual dividends rather than quarterly dividends. And I'm not sure if they're still doing that. Walgreens Boots Alliance, for example, pays dividends every quarter in March, June, September, and December. JP Morgan Chase pays out their dividends in January, April, July, and October. And let me think of another stock, Valero Energy Corporation. They pay dividends to its shareholders in February, May, August, and November. So theoretically, if I own those 3 stocks, then I will receive dividend payment every single month. And sometimes a few companies will pay out extra dividends to their shareholders on a non-scheduled dividend payout date. Now, remember when I owned Costco stock, I don't own it anymore, and Costco decided to pay out what's called a special dividend. And it happens with like a lot of companies too, but they pay out their special dividends to their shareholders because 2020 and 2021 were really good years for them, right? And none of them are obligated to pay special dividends to their shareholders. But when it happens, it's usually because they have excess cash available on their balance sheets, or they want to show confidence in their long-term value. And valuation matters to me when it comes to dividend investing. I don't want to buy something too high of a value with a stock that pays dividends. But it's an entirely different story when it comes to growth stocks, and which is a video for another day. And here's some dates that you need to be aware of when you research dividend stocks, ETFs, and mutual funds. First, the declaration date. And that is the date when the company makes an announcement that it will be issuing a dividend in the future date. And you can go to their SEC investor relations page, and I'll give you the memo declaration of, this is how much we're paying in dividends and stuff like that, right? And second, the record date is when the company looks at its current list of shareholders to determine who will all receive their dividend payments. So let's say fireside chat, right? Let's say my corporation is paying my shareholders dividends, and I'm going to look at a list of all my shareholders to decide who are eligible to receive their dividends, okay? And the third is the ex-dividend date. So this is the date when the company determines which of its shareholders will be entitled to receive the dividend payment. And only these shareholders who hold a company stock prior to this date are entitled to receive the company's dividend. And finally, fourth, this is the payable date. This is when you get the check, right? This is the payment date. And that's when the company pays out the dividend to the eligible shareholders. So when you research the stock and you see ex-dividend date on their website, but that's not the same as the payable date, all right? And you can get all this information again on the earnings report when you search for the investor relations website. So if you want to research Apple, just Google Apple's investor relations. All right, awesome. So the next one would be, let's talk about dividend aristocrats and kings. So when I started investing in dividend stocks back in 2018, I wanted to research and invest in 5 different individual stocks that pay dividends. And when a company consistently pays and increases dividends to their shareholders, they became either dividend aristocrats or dividend kings. A dividend aristocrat is a company in the S&P 500 index that continuously pays dividends to shareholders and increases dividends annually for at least the past 25 straight years. A dividend king is a company that doesn't necessarily need to be in the S&P 500 index, but continuously pays dividends to shareholders and increases dividends annually for at least 50 straight years, right? Usually when I find dividend kings or dividend aristocrats, excuse me, it's consumer goods, industrials, healthcare, financials, utilities, sectors that consistently paid and increased dividends. But keep in mind that just because these stocks are dividend aristocrats or dividend kings, it doesn't mean that they're recession-proof stocks. No, not at all, right? Let's AT&T, for example. They cut their dividends a few years ago and fell out of the dividend aristocrat criteria. And it's important to pay attention to what the company is doing and how it's performing every single quarter and when the earnings comes out. And AT&T, they just kind of like, if I remember correctly, oops, this is not working. There we go. And if I remember correctly, AT&T, they had to like clean up their balance sheet, right? So there was so much in debt. They just acquired like a bunch of companies on their balance sheet, and they were just like, you know what, we need more cash then we're going to have to cut the dividends to the shareholders. So, there were a lot of disappointed AT&T investors when that happened. That was a few years ago. So anyway, let me pull up the Dividend Aristocrat list here. That's me. Here we go. Okay, I want to make sure that you guys can see this okay. And obviously this video is not sponsored at all, or Motley Fool. And I'm just going to show you guys this. Okay, here we go. Oh no. There we go. All right, so when you look at the Dividend Aristocrats, again, obviously they need to be in the S&P 500 index, right? So some of the companies that I recognize right away would be like Procter & Gamble. You'll see that in like toothpaste, toothbrushes, all that stuff. Emerson Electric, 3M, all the masks that we had back in 2020, 2021, they all said 3M on the side, right? Cincinnati Financial, Coca-Cola, Johnson & Johnson, all the shampoo that you'll see is, pretty much most of them will say Johnson & Johnson. Let's see, Target just became a dividend king, and I'll go over that list in a little bit. PepsiCo, and let me go down the list. Walmart is still a year away from becoming a dividend king. Lowe's at 48 years, Walgreens 47 years, McDonald's at 46, Sherwin-Williams, you probably recognize that name. That's from if you ever paint your house, you probably get your material from Sherwin-Williams. ExxonMobil, energy company, Aflac. McCormick, all the spices that you see on the cabinet, that's all McCormick. And the other one that you'll see, like Chevron, Clorox, all these companies, and as well as Caterpillar, you see it in the pharmacy industry. So these companies have been around for not just 10 years, but 20, 30, 40, 50 years that have been consistently paying and increasing dividends for 25 straight years. So let's take a look at Dividend Kings. So the longest paying dividend company is American States Water. And when it comes to dividend investing, I'm really interested in investing in stuff like, utilities, right? Because like even during the recession, and there we go. So even during the recession, we can see that people still need water. People will still go to Walmart. People will still go to Target to get their shampoos and stuff, right? And these are the things that I'm thinking about. But it doesn't mean that they're not going to go underwater. It doesn't mean that they're not going to pay for, they're going to continue to pay dividends because their EPS has decreased. Like they're not getting enough bottom line anymore. So those are the things that you want to really pay attention to. Could we ever see companies like American States Water, Procter & Gamble ever go under, go bankrupt? It's always a possibility, but the probability of that happening is still lower than most companies that I'm looking at. So anyway, when I'm looking at like companies like Johnson & Johnson, right? And they had like lawsuits several years ago about the one of the pharmaceutical things. Probably shouldn't get into on YouTube where I'm going to get banned for it, but lawsuits cost them like billions of dollars, and that probably took some money off their balance sheets. Coca-Cola, one of the companies that Warren Buffett invested in, and I know he has like a huge stake in that. But yeah, again, these are the companies that you can go through and just check them out and see what they are. But you don't need to invest in individual stocks to get dividends. That's the biggest common misconception here, because I want to show you this, okay? And my S&P 500 index fund, in full disclosure, I do invest in the S&P 500 index, and the ticker symbol VFIAX with Vanguard, and it pays 1.56% in annual dividend yield, and that's based on the $369 on the share price. And if you're wondering about your index fund, you can always look at the dividend income schedule, and I'm going to go to distributions here. And Vanguard website has improved pretty dramatically in the past year or so. But if you look at the schedule here, VFIAX pays out its dividends in March, June, September, and December every year. And it even tells you what the share price was when when it was reinvested back into the index fund that I own, right? And in full disclosure, I do invest in another ETF, and this is called VYM, the Vanguard High Yield Dividend Yield. And this one pays 2.88%, if you see on the far right side here. And that's a 2.88% in annual dividend yield at the share price of $109. And it pays a higher dividend yield than the VFIAX. The dividend payout dates are the same as VFIAX, I believe. It is also in March, June, September, and December. And the other popular ETF that I do want to pull up, because people always comment on my videos, is the ticker symbol SCHD, Schwab US Dividend Equity ETF. And this is Schwab's US Dividend Equity ETF, right? The name itself is self-explanatory, and that the ETF is managed by Schwab and invests in US stocks that pay dividends. Excuse me. And this one pays even a higher dividend yield at 3.37%, I believe. Let me take a look here. I can find it, I swear. Yeah, last time I wrote it down, it was like around 3.3%. Yeah, there we go, 3.37%. But also keep in mind that just because a stock, ETF, or a mutual fund pays a higher dividend yield, it doesn't mean that they're good investments. And I will go over that in the private group coaching session later on. And I can't personally tell you what you should invest in, but if you sign up for the private group coaching session on my YouTube page by signing up for the membership program, and I'm going to show you this, and you can't really do it on the mobile, which is really weird. But in the private membership group coaching session, I'm going to do a deeper dive into the FIRE investment strategies and do more personalized Q&As. And this is more of a public live stream with everyone in it. And you can also schedule a free one-on-one 20-minute financial coaching session if you go to firesightchat.com/coaching to discuss your personal finances. And if you're a veteran, and I do personalized finances with veterans, you can get a free 30-minute coaching session. And I do want to just bring up the complimentary coaching session real quick. And I did get some flags in the emails that, hey, there are no available dates until April. And I'm not trying to brag or anything, but the schedule is absolutely full. And I'm sorry, it's so full right now. I'm trying to make more time slots available, but between filming, between making YouTube videos, between actual, like clients, paying clients that I got to help them out with, it's just that there's almost no time, no additional slots that I can make for the complimentary coaching session, because those are the sessions that I really want to get to know you guys and find out what it is that you need. Because as a financial coach, what most people don't know is that even a licensed financial advisor, right? If I were let's say a CFP, I still can't give you a personalized financial advice. I can't do that. It's just can't legally do it. What I have to do is actually, as a financial coach, I can teach you what an index fund is, but I can't tell you if you should invest in that index fund. And I can't tell you how to allocate your strategy, right? And that's why when I go on air like this, I'm just talking about my strategy and my risk factors, my risk management, how it is that I'm trying to achieve financial independence, those kind of things. So that's what I get to talk about, is what I am doing. Okay. So, yeah. Yep. Love them. VTI, VOO. Love them in my taxable investment account. And how much do you consider the expense ratio when choosing these dividend accounts? Okay. So I know the VYM, just closed the window on that, but that one does pay about, is it 0.0? I think it's like 0.1% in expense ratio. I always kind of look at I do always look at the historical performances before I look at the expense ratio. And most index funds, and ETFs can be index funds too, they tend to have lower expense ratio. So if it's like under 0.1%, and sometimes I think it's like healthcare sector ETF, it was like 0.13%, which is still significantly cheaper than some of the what other banks or brokers offer with a 1% or 2%. I just want to make sure that it's not going over that. And if I had to make a threshold, in my opinion, this is me, it's probably anywhere under 0.25%. That would be the maximum expense ratio that I would look at, unless this is something that I am like, hey, this is a high growth ETF or index fund. Like there's I think it's like VGT, which is the Vanguard Technology ETF, which has a really high growth, right? And that's the one that I'm going to be, I would be okay paying a little bit more than 0.25%. But yeah, now that you asked that question, I never really kind of, made a threshold of how much can I pay at the maximum for that, right? So anyway, yeah, thanks for the question on that. That's really good. All right. Yeah. So I had a question from Facebook, private Facebook message that, this is going to be, this is all public live stream. I'm going to do this every other Wednesday. So after this session, though, I'm going to do a private coaching session, private group coaching. That's also going to be free for you to watch. But starting in March, on March 1st, that's going to be for members only. Okay. So there are people who sign up for the members only. I have my private clients who want to watch that. They can. And you can go to my private Facebook group, or not private Facebook group. You can sign up for that too. But go to my YouTube page and you just click on join, and you just select the membership level. So you can go from there. So anyway, cool. No, thank you, Sim. Appreciate ya. All right. So let me get back into dividend reinvestment. Press these buttons. Cool. All right. Not that one. There we go. All right. So let's talk about dividend reinvestment. So when you look at let's say you start investing into dividends, right? And you get that, you get like $5, $10, whatever the amount is. You get that dividend payment. You're like, oh, you're super excited about that. But let's say in my first year, this is how you calculate, right? You can always reinvest, or you can take the money out. I always choose to reinvest my dividends. So let's say, again, I invest $10K in lump sum, okay, into a dividend stock or ETF that pays 3% in annual dividend yield. And I know this is highly unlikely, but I'm going to assume that there are no capital gains in the $10,000 that I initially invested, just for teaching purposes. So by the end of year one, I will receive $300 in dividend payments, because $10,000 multiplied by 3% is $300. So the ending balance would be $10,300 with a 3% total gain with a 3% dividend reinvestment, right? So that's my ending balance, okay? So in year two, I'm going to label that year one. Here we go. Okay. In year two, and I say, you know what? I'm going to invest another 10K into it, all right? And that's going to be a total, because I'm going to add 10,300, total at 20,300, okay? And when I get another 3% in annual dividend yield, that's going to be $609, I believe. Did I do that right? Yep, $609 in dividend payment. So by the end of year two, I would have a total of $20,909 totally invested. So I'm consistently getting a 3% gain with the dividend reinvestments every year, assuming that the dividend yield remains at 3%, right? But what if I had a 5% capital loss in the investment. All right. So let's say my investment is now 9,500 from my 10K initially invested because of that 5% loss. Okay. I'm going to make it all fancy. Okay. The dividend yield is going to be higher because the share prices have decreased, right? And let's say the annual dividend yield is $2. Okay. And the stock price is now decreased from 50. What is that? 5%. So that would be 47.50 a share with a 5% loss. Okay. The annual dividend yield will now increase from 4% to, let's see, 47.50 divided by, yep, so that would be 4.21%. Okay. How did I get that? And I just do 2 divided by 50, it's 0.04, that would be 4%, and 2 divided by 47.5, that's the $47.50 in share price that has increased, and that would be 0.0421. Let me know in the comment section if I messed up that math, right? And that would be 4.21%. And just because the dividend yield is higher, it may seem like you're getting more dividends, but the reality is that you have lost the value of your investment while making the same dividend payment. So with a 3% dividend yield, I would have a net loss of 2% in a year. But what if I had a 5% capital gains in the investment? Okay, so that will be from 10K initial investment. Okay, same thing, it will be a $2 in annual dividend yield. And with the $50 market share. So with the 5% gain, what is that? That would be $52.50 per share. Okay, let me know in the comment section if I messed up that math. And I probably, nope, I didn't. I'm pretty confident in that one now. With a 5% gain, okay? So $2 divided by $52.50, that will give me 3.8% in annual dividend yield, which decreased from 4%, right? So time to panic. Now the dividend yield is lower. No, that's not the case at all. So with 200 shares, multiplied by $52.50, that would be 10,000. Oh gosh. There we go. That would be 10,500. So I got $500 in capital gains, which is a 5% capital gain. And if I multiply that by 3.8%, quick math, that's about 400, 399. But okay, we'll just say 399. So the total, running out of space here, I would have, with the dividend reinvestment, would be $10,899, or a total of 9% in capital gains and dividend reinvestments. So not only I got a 5% capital gain, but I also got a 4% annual dividend payment. And keep in mind that individual stocks are always much riskier than investing in ETFs or mutual funds. And, just remember, and if this is confusing to you, just go back, rewind a little bit. And, last time I did this live stream, people were telling me that I was going too fast, and that's why I slowed down. But just go back and rewind it, watch it again on how this is calculated. Just because the dividend yield went down at 3.8% from 4%, it doesn't mean that you're going to lose money on the dividend payment. Okay. It's just that the dividend yield has decreased because the share price has increased. The best case scenario every year to me is that I get capital gains, let's say 5% every year. That'd be awesome, right? And I get 3% in annual dividend yield in dividend reinvestment. 5% capital gains and let's say 4% dividend yield. That's 9% gain every single year. And this is another reason why I absolutely love having dividend investment in my taxable investment account. And I'm going to talk about the early retirement strategy. But before I go to that, make sure you get my financial independence resources for absolutely free. And just go to firesidechat.com/contact. It's so, people are, I had someone criticize me. It's so weird. The comment section sometimes, they say, why are you giving out free stuff? You could be charging people these, free, these financial resources, spreadsheets that you spend time working on. To me, all of these financial resources, you can find them online. They're free. And I never want to do like courses. I believe in like these interactions with the audience. People get to watch this video again and just kind of talk about it, have questions, Q&As, because the financial world is constantly changing. We're constantly evolving. But the financial resources that I have on that website, when you visit it, it's all free. And you can go to like websites like NerdWallet. They have all the resources. You can get them for free too. But I have my own resources that I use that's been working out great for me. And I want to share them with you because I don't need to sell them, right? And if you truly want to help me and my channel out, is to go to my private group coaching session or become a private member or get a individual coaching sessions, or I also do couples coaching session. So yeah, you can go to that, and that would be the firesidechat.com/coaching. So check those out. All right. So anyway. All right. So the next one, told you I was going to have a lot today. Now let's talk about taxes. How much are you going to pay in taxes? So not a CPA, but I do have my own dividend investment with the tax strategy in place. So it doesn't matter if you're withdrawing or reinvesting your dividends every year. You will owe the taxes on the dividend distributions. But here's the big difference. You get qualified dividends and non-qualified dividends. And qualified dividends, they're taxed at 0%, 15%, or 20% in long-term capital gains tax. And non-qualified dividends are taxed at your ordinary income tax. So if your marginal tax rate, income tax rate is at 24%, then you could pay 24% of your non-qualified dividends. And I'm going to explain what those are. So how do you know if you're getting qualified or non-qualified dividends? A qualified dividend needs to be paid by a U.S. corporation or by a qualified foreign corporation. So if you invest in a foreign stock on the New York Stock Exchange, then the dividends could be categorized as qualified dividends, but make sure you confirm that before you invest, okay? Oh, excuse me, I had to burp there. It also needs to be regular dividends and not capital gains distributions. You also have to hold a stock for more than 60 days during a 121-day period, beginning 60 days before the ex-dividend date. If you don't know what ex-dividend dates are, you can just rewind this video about 10 minutes or 15 minutes. The one thing to keep in mind is the real estate investment trust or REITs, because they are taxed or master limited partnerships or MLPs, because they're not structured as corporations for tax purposes. So if I'm investing in REITs or MLPs, any dividends I receive from them are considered non-qualified dividends and taxed as ordinary income tax. So with that in mind, let's say I have $1 million invested in my dividend stock portfolio, and that is yielding 4% annually. Okay. So that means I will make $40K a year, right? Or $10K every quarter. That'd be awesome, right? If you had $40,000 a year in dividend income. So $40,000 a year while I'm actively employed and making other income would probably put me in the 15% capital gains tax bracket, which is still not as bad as 24%, 32%, or 35%. So that would be roughly $6K in taxes every year out of the $40K. So that leaves me with $34K every year, right? So the net dividend reinvestment would be 3.4% after taxes and maybe management or brokerage fees. But let's just say that I retire early. Okay. See if I can erase this. There we go. Let's say I retire early and I have no active income. I could get these dividends tax-free. And let's look at the, here, let me show you why. What people forget, and we're so focused on the 15% capital gains tax rate because most people have active income. But when I'm in my early retirement, my wife and I will continue to file our taxes jointly, right? Married, filing jointly. And so we can receive our qualified dividends income up to $89,000. Well, I'm sorry, that's the wrong one. There we go. $89,250 up to $553,000 in that's taxed at 15%. But this one is all taxed at 0%. How incredible is that, right? Which is still lower. At 15% is still lower than the ordinary income tax. And if you're single, and make sure this is a distraction here. And if you're single, it's half of that. So up to $44,625. So would it be better if you're married? Yeah, for tax purposes, it would be better, right? Not saying that everyone should get married. I get that. So keep in mind that these dollars are adjusted by inflation every year. So last year it was like $84,000 or something like that, but they adjusted by inflation. So this $89,250, where do you think that's going to be in 8 or 9 years, right? In 10 years, in 15 years? It's going to be a lot higher, right? Because of inflation. So these dollars will probably go up to $100,000 or $110,000 for the 0% capital gains tax rate. That's what I'm saving for. And I know that I'm not going to have an active income, so I'm going to bank on that 0% capital gains tax rate. Am I going to have no other income? No, right? Now I'm still going to have other active income. So after all the deductions and, I have my own CPA, I'm still going to save a lot of money on the dividend taxes because they're taxed as long-term capital gains. Anyway, let's do some reverse math, all right? So let's do some reverse math here because I like to do stuff like that. Merry bonus or merry reward? I don't know what you mean. Is that is it because I made a comment about the marriage? Okay. Let's do some reverse math and using today's tax bracket. Let's just say $89,000 in qualified dividends. Okay. So $89K a year is how much I want to live on. Okay. With a 4% annual dividend yield. So I divide that by 4%. Hey, Alexa, what is 89,000 divided by 4%?
89,000 divided by 4% is 2.225 million. By the way, you can thank the driver of your most recent delivery, and we'll share your appreciation with them.
Yeah, okay. Thanks, Alexa. Okay, that's why I have Alexa. Yeah, that was too big of a numbers for me to figure out. But divided by 4%, that would be $2.22 million, right? And if I had $3 million invested, yielding 4% annually, that's $120K a year, right? This is before the standard tax deduction. So I could potentially make $120K a year in tax-free dividend income in the year 2033 or 2035. And if you're if you're brand new to my channel, and I've been talking about this for the last 2 years, is that my retirement age is going to be 45. After that, I'm done. It doesn't mean that I'm going to quit all of this. I'm going to continue doing what I love to do. But just imagine having 120K a year, right? Yielding 4%, 3 mil, or probably less than that. Let's say 2 mil, making 89K a year, tax-free. How awesome would that be, right? So anyway, that would be the investment strategy. So Q&A. If you guys have any questions, let me know in the chat. And I have some questions from the private Facebook group. Let's take a look here. Chase, thanks for your question. The market went to crap last year. It sure did. So I moved money out of the C and S funds and put everything in G fund. I actually made 3% in return instead of losing 15 or 20%. Should not have done that. Okay. So again, I can't tell you what to do. I can't tell you about your what you should do with your allocation strategy. If you feel like you made the right decision, then stand by that decision. Okay. What I did last year with my TSP is I just kept everything in C and S funds. That's what I do, not personalized financial advice. Can't tell you that. I didn't put any money in G fund because when we lost, what was it? 18% in C fund, and it was like close to 30% in S fund for the small and medium cap stocks. I knew the upside was going to be a lot higher going into 2023, 2030, 2035. I am not touching my TSP until at least 2050. So I could care less what happens with the TSP now, what happens to the TSP tomorrow, what happens to the TSP next year. Don't really care. I'm going to continue to contribute, continue to invest in those funds, right? But that's just me. However, sorry about that. However, if you're close to your retirement age and TSP is your source of income and you need that to pay for your expenses, then you need to consider capital preservation. How you should do that, I can't tell you. But what I would do, and I can't help you as a financial coach on this, and I would recommend you a CFP or CFA to talk you through that allocation strategy, right? You might need to put, I would probably put more into bonds or something like that. And I'm not saying that you should, to prevent the losses if I'm going to withdraw that money within the next year or two, right? Probably 3 years. So when I'm close to my retirement age, because TSP I'm not touching now until I'm 59 and a half, or maybe beyond that, I'm going to leave my money where it is now. And when I'm like 3 years out from retiring, I'm going to look at what's going on with the overall market and determine if I should keep money in there. The one more thing that I would consider also is that it's not just the TSP I'm looking at, right? I have several investment accounts. So I want to look at my entire net worth, my entire investment portfolio. If I'm already investing, if I'm already investing this much money in bonds in another taxable investment account, if I'm already at, like, let's say 10% of my net worth is in bonds, then I probably don't need to worry too much about the TSP, right? Everyone's situation is different. So hopefully that answered that question. Just make sure that you talk to someone about your TSP allocation strategy. And I feel I can't help you with that, but hopefully you got something out of it. And the next question from James, I have $30,000 in credit card debt, and I'm thinking about taking out a HELOC to pay off the high interest credit card debt. Is that the right move to do? So you're playing the numbers game, right? So you're thinking about, hey, I have 30 grand and you're probably paying like 25% in interest. And you're thinking about HELOC because you have an equity in your home that you've been living in the house for however many years. I don't have that in the question. You have to think about why, how you got $30,000 in credit card debt in the first place. Because once you move money or you take a HELOC out, and you pay off your credit cards, and then what? You add more credit card debt to your debt. So you didn't just solve the root cause of your debt problem. You just kind of move one debt to another place, right? This is a common question that I get, and I made a video about HELOC. I'm going to pull it up in a minute, but I did make a video about HELOC and the pros and cons of putting out a HELOC. So make sure to look up that video. But the short answer is no, I would not take out a HELOC, because not only am I using my house as collateral to pay down that debt or pay off the debt, but what if I didn't really, solve the real problem that created that $30,000 in credit card debt in the first place? So that's something that I will look at and say, am I budgeting properly? Do I know where all my dollars are going, right? The other possibility is that you're not making enough income. So your expenses are too high and your income is too low. So that's one thing that you need to pay attention to is you need to look at your budget first, right? The ultra rich people, they still budget. They just hire someone else to do it. So if you don't budget and your expenses are too high and your income's too low, and you're taking out $30,000 in credit card debt and you just keep maxing out your credit cards, taking out a HELOC is just to treat the symptom. It's not treating the root cause of the problem. So if you need help with that, I can walk you through the problem. And I did make a video on how I paid off $47,000 in credit card debt in 2 years. So you can check that out. But if you need help with it and you want to have that complimentary coaching session, just go to firesightshare.com/coaching. Thanks for the question. All right. So the next one is, what do you think is the best passive income stream? Real estate or stocks? This is really good. So I don't believe real estate is passive income. I never believed that. It's just, some people I know in the fire community, they say I would never do real estate. And I completely understand why. If you hate dealing with people, don't do it, right? It's a lot of work. It's not just, hey, I'm going to buy this real estate property. I'm going to put $50K down and I'm making, 10% return every single year. Yeah, cool. Don't forget about the only variable in the entire balance sheet that you have for real estate is your tenants. Your tenant could really mess up your real estate portfolio if you don't have like the expenses, capital expenditures. You don't have some money set aside in case your tenant falls, slips, whatever happens, right? What if the tenant decides not to pay you rent? That's another thing. And there are a lot of horror stories about real estate. I'm not trying to scare you on that, right? But I would never say that real estate is passive income. I don't think it is. And the only real estate that I own right now is my home. And the only people I have to deal with is me, my wife, my daughter. Not that they're bad tenants, but I'm saying that, that's all I have to deal with. The easiest passive income stream, in my opinion, is dividends. And I just talked about it for the last 45 minutes. Dividend investing strategy. I can literally go into my stock portfolio right now and I say, I want to buy some Caterpillar stock because I believe the farmers will continue to buy Caterpillar equipment, right? And I get paid 3% in annual dividend yield. I don't have to deal with anybody at all. I just put my money in a stock, or I put money in an ETF, I put money in a mutual fund, and they pay me dividends. I go to sleep and I just wake up and then boom, there's a dividend payment. Congratulations. Thanks for, investing with us. That's awesome, right? If you read the article about Warren Buffett, if you don't know who that is, he's like one of the richest billionaires in the US. A lot of respect for that guy. And his company is set to make something like $4.6 billion in annual dividend payment in 1 year. And somebody did the math a while ago. I think I saw like on TikTok or something like that. He's making like $8,000 every minute or something like that in dividends. It's something insane. But just imagine, right? Like I know not everyone's going to become Warren Buffett. Not everyone's going to become a millionaire or a billionaire. But imagine having that $1 million invested in the dividend stock portfolio. Say $1 million invested in a VYM or SCHD with the Schwab. I mean, that's still $30K, $35K every single year that you get from dividends. So in my opinion, I think stocks or dividends are the best passive income stream, in my opinion. Some people enjoy doing real estate. Awesome. I think you just have to be extremely careful when it comes to real estate investing. You need to know who you're putting in your house. And I think the worst business practice is actually doing business with your family members. I don't know why, but some family members feel like I don't have to pay that person rent because it's family or she's family or something like that. So, I will stay away from that, and I will make sure that you have enough cash set aside for that rental property. Anyway, really awesome question. Thank you. All right, so man, I'm losing my voice here. Okay, so the next part is the private group coaching session, but it's free for everyone to view. Oh yeah, I know, Alexa. Oh no, never mind, Alexa. I can't even say that name because that's she gets all crazy. But yeah, it's pretty awesome. Anyway, all right. Okay, so welcome to the private group coaching session. So this one is free for everyone, and this is going to be the very last private group coaching session. And starting on March 1st, it's all going to be set to members only videos. After that, you'll need to sign up for the private membership program by visiting Fireside Chat, my YouTube page at Fireside Chat. And if you're still watching this on replay, just be sure to check out the live stream I did on the dividend investment strategy. So first, I want to talk about valuation. And the purpose of group coaching is to answer as many questions as I can. And I know a lot of you are interested in finding the right investment strategy that's suitable for you. Just keep in mind that you know what's best for you, okay? Just because it's working out for me, it doesn't mean that it's going to work out for you. And I can't give you any personalized financial advice. I'm going to share what's been working out for me, and hopefully you can learn something from it. So anyway, first, I want to touch on valuation because many of you asked. When it comes to dividend investing in individual stocks, valuation matters to me. I don't want to buy something that's too high in value. So a few things that I look at are the forward PE and the 52-week high and low prices. And that's just for individual stocks, though. For ETFs, I'm just consistently investing in every single week. And to me, investing in ETFs has been rather stress-free as long as I know the basket of stocks that they're investing in, right? One thing I am keeping in mind, though, is the dividend payout ratio. And I choose to invest in these individual stocks because, for one, I enjoy doing research on these companies. And I love to read their 10K or 10Q reports. But anyway, the dividend payout ratio is dividing dividends paid by earnings after tax and multiplying the result by 100. For example, if a company stock pays me dividends per share of 50 cents, this is how we do dividends. 50 cents, okay? This is the most simple math I'm going to give you. And the earnings per share, it's EPS, is $1 per share, then theoretically, the payout ratio would be 50%, because 50 cents divided by $1 is 50%, right? So why does this matter? Because when companies, and this is my rule of thumb, this is my own personal rule of thumb, when the company pays out too much in dividends, now they're not putting enough money back into their companies to do research and development, to expand their business, to grow their company, or to get new products in line, right? So those are the things that are really important for me to see. And I get that companies like, let's say McDonald's, they're franchises, right? So what they make, they make money from the franchise fees. And the McDonald's is like probably the biggest fast food franchise in the entire world, right? I remember going to Japan and they had like McDonald's there. Going to Korea, they had McDonald's there. And going to Europe, they still have McDonald's. So they, when their EPS, and I'm not saying McDonald's EPS is $1, but the EPS at $1, and they decide to pay half of their EPS to their shareholders, that's fine. But when it get my threshold is really between 60 and 65%, right? So a couple factors I want you to consider is the EPS. When the EPS drops, that's the bottom line. So when the bottom line drops, they either have to decrease their dividends, right? Or they have to cut their dividends. And most companies don't want to cut their dividends because, again, being a dividend aristocrat or dividend king, put them on that chart and make people trust them. Do people still trust AT&T? Sure, but they don't have as many investors as they did before because they cut their dividends, right? So those are the things to look out for. So when they drop their EPS, they either have to cut or maintain or increase dividends. So what happens when they increase the dividends, right? Say they drop that. Now it's going to 60%, 70%, or 80%. And I have personally seen some companies that pay over 100% of their EPS to their shareholders. And that's a big red flag to me because now they're borrowing money to pay their shareholders dividends and they put themselves in holes. That happens a lot with the small cap and medium cap companies, usually in utility sector or energy sector. Okay. So really pay attention to the dividend payout ratio when you're doing the research. Now, let's see. Do I have the McDonald's pulled up? I do have McDonald's pulled up. All right. Let me pull up McDonald's quarterly earnings as an example. And they declared, oh no, there we go. Okay. So this is the most recent one that I was just reading of. It came out on February 2nd. I'm going to zoom in here. So McDonald's board of directors declared a quarterly cash dividend of $1.52 per share of common stock payable on March 15, 2023 to shareholders of record at the close of business on March 1st, 2023. You see what I was just talking about during the public live stream, declaration date, right? Record date, payable date. That was all in that one sentence, right? March 1st, March 15th. Anyway, the EPS from the last quarter, can I write on this? Nope, I cannot. Okay. So McDonald's dividends, $1.52 per share. And the EPS from last quarter, I think it was $2.59. Yep, $2.59 a share. Don't ask me how I remember that. I just do because I'm a nerd. So the dividend payout ratio, Alexa, what is $1.52 divided by $2.59?
From defenseworld.net, this represents a $1.68 annualized dividend and a yield of 2.52%.
Oh, did not give me the answer. Okay, thanks. So do the math real quick. That was 52, 259, 50. Okay, so the payout ratio would be 58.7%. Okay, that would be the dividend payout ratio here. All right. I'm just going to go ahead and round that up to 59%, just based on the EPS and the dividend per share. I'm personally fine with the payout ratio as long as it's under 60%. And if it's more than that, then I suspect that the company's either hurting on its bottom line or it's overpaying its shareholders. And companies that don't reinvest in their businesses will have a harder time expanding. And I use McDonald's as an example, but you can basically use the same formula to divide total dividends by net income, and it will give you the payout ratio. And what I'm investing in my dividend stock portfolio right now, it's yielding about 4% annually. But please don't invest in the same stocks or ETFs I do in my account just because I do it. And you should do your due diligence before investing in anything. And so, yeah, make sure you do your own research. And in full disclosure, I have Pfizer. That was my new stock about a year and a half. Nope, that was about 6 months ago when it went down. Verizon, JP Morgan, Raytheon. I've been holding that for a long time, and Raytheon has been doing very well for me. And the other one is WBA. These are the 5 stocks that I'm going to hold on to, and I'm going to invest probably for the rest of my life. And I like to find stocks that are undervalued and pay an increased dividends for many years to come. And I believe these companies will appreciate in value and increase their dividends every year. Could these companies go bankrupt? Highly unlikely, right? But there's always a possibility. And that's why I like to keep up with those companies to make sure they don't become bad investments. So, but I'm sticking to just 5 stocks, and I'm looking to find the next 5 dividend stocks. And I'm going to show you what I'm doing here. So my strategy since 2018 has been the same. I wanted to invest in 5 different stocks with $10,000 each. And I've accomplished that. And now I'm moving on to the next goal, which is to invest $250,000, which is 10 stocks and $25,000 each. Theoretically, I could just invest in an ETF or a mutual fund that pays 3 or 3.5% in the annual dividend yield. But where's the fun in that, right? I love doing the research. That's why I keep doing it. That's why I love reading these reports. And when I reach $500,000, I like to have at least 15 or 20 stocks with $30,000 each. And I like to have 20 stocks with $50,000 each when I reach $1 million. But who knows? I might get tired of doing the research on these individual stocks and just switch to an ETF instead. Highly unlikely though, because this is my passion and obviously not for everyone. And I get that. And I never encourage anyone to invest in individual stocks. I never do that. I believe, the easiest way is to, you look at the basket of stocks and see what they're investing in. You still need to do the research though. But you don't need to, doing the individual stocks require more in-depth strategy and more reading required. And not everybody likes to read, and I get that, right? And I'm investing in my dividend stock portfolio only after I maxed out my retirement contributions though. So my early retirement year will begin in the year 2033. And I should have at least $1 million invested in my dividend stock portfolio, if not more. And if I could just make $40,000 a year in dividend income, it's going to be more than enough to pay for my everyday expenses because I will have other income streams. Dividend income is just a small part of it. And I'm not just going to have the dividend income. I'll have the interest income, real estate income, royalty income from YouTube AdSense, capital gains from stock appreciations, and business income from Fireside Chat. And if you're committed to achieving FIRE, you should never just rely on one source of income to retire early. You want to work on expanding your opportunities, but diversifying your investments, right? And this is a really good question from Jacob. And let me see if I can pull it up. I can't pull up okay, never mind. From Jacob, it says, does the annual dividend count towards the annual contribution to my 401k or IRA? Great question. If I invest $6,500 or contribute $6,500 to my Roth IRA, and I make $500 from dividend reinvestment, that dividend reinvestment does not count towards my contribution. If I get dividend reinvestment from 401k, that does not count towards my contribution limit. It's just in addition, right? So that's another awesome thing about dividends is that I know they treat it like it's not exactly a capital gain, because capital gain, you don't sell it. You make the gain when you sell the stock, but dividends, you still have to pay taxes whether you take the money out or you reinvest the dividends, either way. So no, it does not count towards the contribution. Anyway, had a great time today. I really appreciate you guys being here. That was just over an hour just talking about the entire dividend investing strategy. If you're watching this on replay, let me know in the comment section down below what you learned about it. And I have plenty of other videos about the dividends. I can't give you personalized financial advice, but just kind of like the concept of it, right? Those are the things that I want you guys to get to know, because this is all free information out there. People just don't know because it's not really advertised and say, hey, invest in my stock or ETF or mutual fund for your financial independence. And guess what? I'm going to give you more money and to reinvest in it. How awesome is that, right? We talked about passive income streams earlier. The easiest passive income streams, I believe, are literally dividends, right? So I wanted to get into to the live stream today to get to know you guys, and I appreciate you guys in the private Facebook group. And I will have another public live stream session in 2 weeks on a Wednesday. And sometimes I do special live stream when we get CPI reports or the Federal Reserve. And I know we got the Federal Reserve meeting minutes later on. But if you want to join the private membership group, just go to my YouTube page and just click join. You have to do it from the desktop though. I don't know why they don't have the mobile version, but anyway, I appreciate you guys all being here. I will see you guys next time.